Hi, I want to talk about the 6 keys to financial independence. First, what's the impact of interest payments on my credit cards? Second, what is the importance of emergency fund? Third, don't use buy now, pay later. Fourth, what's the impact of investing in the S&P 500 over a short period of time versus a long period of time? Fifth, what's the impact of inflation against my investments? And sixth, what does it mean to save first and spend the rest? What is the impact of paying credit card interest over time? In this example, I'm showing $20,000 of credit card debt at 25% interest. What happens if I pay $500 per month? It would take me approximately 89 months to pay that off. That's almost 7.5 years to pay this credit card off. The total interest that I would be paying would have been $24,000. So my initial purchases was $20,000, and then I paid $24,000 of interest over that period of time. So this is one of the biggest killers in people's finances, where you should never owe money on credit card and pay that much interest. If I change the monthly payment to $750 a month, then we pay off this credit card in 40 months, only paying $9,000 of interest. But when I say only $9,000 of interest, that's a lot of money to throw away just because I wanted to buy something now to feel good about purchasing something, and I'll pay that interest later. And what I'm trying to bring up is the interest is such a big killer to your finances. We should not be paying any interest. Therefore, if you don't have the money to pay off the purchase in full, you shouldn't be buying the things. A common problem that my clients face is having unexpected expenses coming up to fix their car, their kids. Maybe it was a medical issue, maybe it was fixing their house, and not having any money in the bank to pay for it. Then they have to borrow money on credit cards. The solution to this is to have a large enough emergency fund. The emergency fund would consist of 3 months to 6 months of your living expenses in the bank, preferably in a high yield savings account or US Treasury bills, to earn interest. And it is easily accessible in the event of those emergencies. Then you don't have to borrow money at exorbitant credit card interest rates of 25% or higher to pay for these unexpected expenses. And when we say they're unexpected, we know that they will be coming, so it's a little bit confusing when we say unexpected, but expected. Next, I want to talk about why should I not use buy now, pay later. While it seems attractive and tempting to purchase items and pay monthly payments with no interest for 1 month, 3 months, 6 months, etc., and I get to have my toy earlier and I pay it later, it becomes very easy to start stacking a lot of payments to buy something today and not really keep track of how much money I'm actually spending because everything is free and I'm just looking at the monthly payment. So my recommendation is never use buy now, pay later, because it's so easy to get in that habit of I want this, I want that, so I want to buy. I get caught up in not calculating how much I'm really spending. The worst option in buy now, pay later is if they have interest rates. So then it's like borrowing money on a credit card to, again, deal with the issues of I want to buy something today so I feel better, but I don't want to think about how I'm going to pay for it. So I'll just put it on a pay later because I can't afford to pay for it right now. So instead, you should switch to don't use buy now, pay later at all. If I don't have the money, don't buy it. What is the impact of investing in the S&P 500 over a long period of time versus a short period of time? In this example, I'm going to show a $100,000 one-time investment plus a $1,000 per month contribution over 10 years from 2015 to 2025. Let's take a look at that. So the blue line is the total of my contributions. As you can see, since I'm contributing $1,000 per month, the total contributions is going up all the way to $221,000 over this 10-year period. The purple line shows the value of my investment into the S&P 500 index and unmanaged indexed, and it shows the value of my account, what it's doing over this time period, and growing to a total of $485,000. If I change the time period from 10 years to 20 years, we can see the total contributions went to $341,000, but my total account value grew to $1.2 million over this time period. If I change the time period to 30 years from 1995 to current, then we can see the total contributions continually rising because of my $1,000 per month contribution to a total of $461,000. The value of my account, however, grew to $2.5 million. So this is over a 30-year period versus 20 or 10. If I change the time period to a 40-year period to 1985, we can see my total contributions goes to $581,000 and my account value grew to $6.6 million. So you can see the dramatic impact of investing money over a long period of time. However, and I want to show some great examples of what is market volatility and how it's impacting my account. So for example, in 2000, my account would have peaked at $1.4 million and then slowly went all the way down to $856,000. So if I was panicking and decided I need to get out of the stock market because I'm worried it's going to go to zero, then I would have missed out this tremendous run back to $1.6 million. Then we had the great financial crisis when my account went from $1.6 million went down to $800,000, losing half of my money. Again, very scary times. You can see I'm still above my total contributions, but then if I decided to get out and panic and then not get back into the stock market, I would have missed this dramatic run in the stock market here. And again, during COVID, $3.9 million, 1 month later, dropping down to around $3 million. Very big decline here, as well as in 2022, 5.5, dropping down to $4.5 million. So that's $1 million loss during that time, but the percentage is identical. So the point I'm trying to make is invest money over a long period of time. Number two, keep your money invested. Don't get in and get out. Be patient over time. In this next chart, I want to show the impact of $1,000 per month contribution over 10 years and comparing that to the different values. This time, I'm doing this without a $100,000 upfront contribution to give us an idea of how much did my money grow investing in the S&P 500 index. If I did invest it over 10 years, $122,000, the value be $219. So let's look at the gain on the right side is $97,000 gain. So when you compare the additional contribution of $120,000, which is over 20 years, my account would have grown to $491,000, and over 30 years would have grown to a gain of $1 million, and over 40 years, a gain of $3 million. But what's very interesting is you put in $100,000 more each time from the 10 to 20, the 20 to 30, the 30 to 40, and the gain is dramatic. So having your money invested over a long period of time is making a dramatic impact. On the bottom part of the chart is going back to the $100,000 contribution plus $1,000 per month contribution. You can see the gain on after investing for 10 years would have been $264K versus 20 years, $859K gain, 30 years, a $2 million gain, and 40 years, a $6 million gain. So you can see the impact of having your money invested over a short period of time versus a long period of time. So this is very important if I'm saving money for retirement and having a big impact. The earlier I can start, the bigger the impact I can make. Keep in mind, Past performance is no guarantee of future performance. Investing in the S&P 500 index is an unmanaged index and cannot be invested in directly. Next, I want to explore what is the impact of inflation to my spending power. What this is showing from the U.S. Bureau of Labor Statistics, it shows if I wanted to buy something for $1,000 in 2015, how much would it cost me if I wanted to buy the same thing today? It's $1,368. If I change this to 2005, a total of 20 years, that means my $1,000 of stuff that I wanted to buy now cost me $1,676. If I change this to 1995, so 30 years ago, my $1,000 cost me now $2,000, $2,127. What this is saying is inflation has made my buying power cut in half, and whatever I spent $1,000, now I have to spend $2,100 to get the same thing. And if I go back even further to 1985 and go back 40 years, now it's 3 times as much. So I need 3 times as much money to pay for my expenses today than I did 40 years ago. So this is a dramatic impact of how inflation can impact your investment values. Finally, I want to talk about the last point: save first, spend the rest. Most people spend money every month on whatever they feel like buying today. I feel like I want it, I buy, and then based on my bank account, as it gets smaller and smaller, or my credit card bill gets higher and higher, then I want to spend less, and oops, I spent too much and I can't pay it all off the next month. So the better way to do this strategy would be to set up your credit cards to pay off in full every month. Therefore, you know exactly what you're spending. However, the better way to do this is to identify what you're spending on a monthly basis and how much you'd like to spend on discretionary items, and decide an amount that you wish to save first. Therefore, you're making a monthly contribution out of your account to save money first. Then you're spending the rest of your money, but you already created a plan of how much do I want to spend on my monthly budget. Therefore, I'm going to spend that after I save my monthly contributions.